This is Eric Thompson. I'm the CEO and lead investment advisor for Peerless Wealth, a registered investment advisory here in Columbus, Ohio. As always, thanks for tuning in. I like to talk about topics that I'm getting questions on, that I'm reading about in the news, and that the majority of my clients and future clients can benefit from. And I thought I'd talk a little bit about gold. And before I do, I want to cut to a clip from one of my favorite comedies. Hope you enjoy.
I love gold. The look of it, the taste of it, the smell of it, the texture.
So that's a funny movie. That's Austin Powers and Goldmember. It's actually one of my favorites. I like the first one a little bit better than the sequel, but both are definitely my type of comedy. But I think it's interesting because Goldmember, the villain in the movie, is a lot like what I'll call a gold bug in the investment world. They're just fixated that gold is the solution for every financial catastrophe that's out there. And every few years, and it's typically during times of financial turmoil, market turmoil, inflation, political unrest, wars, you name it, the worse the headlines are, the gold bugs seem to kind of emerge almost like the cicadas do after hibernating for 15 or 17 years or whatever it is, and they come up and they make, in fact, probably more noise than the cicadas do. And whether you're reading an article online or whether you're thinking about this to themselves, oftentimes it ends with, sell whatever investments you are in right now and buy gold to protect your family and get through the impending doom and gloom and Armageddon and the end of the world. And oftentimes my clients read this, and it's usually during times of turmoil, so why wouldn't you want something that might be a safe haven or might be a cure for maybe some temporary decline in stock prices? So I'm a fiduciary. I'm a fiduciary of client portfolios. I'm obligated to make the best financial and the most honest financial decisions I can for the client. My fees are based on the value of the client's account. So I certainly don't want the account to go down. I'll take a pay cut. I want it to go up. So it's in my best interest to look at every asset class I can, and gold is one of those. And I've looked at this before, but I thought it deserved a fresh look. And I wanted to share the results that I uncovered with some research with the viewers today. So with that, I created a chart, and you'll see it up here on your screen here. And what this is it's the return of gold versus the Wilshire Large Cap Stock Index. So we're basically comparing gold to stocks. The Wilshire Index is very similar to the S&P 500. And what I'm trying to show here is if you put a $10,000 investment in each one over the past 10 years, the past 30 years, and the past 50 years. And how would you have done? So the first line there is the previous 10 years. So roughly, where are we, 2022. So roughly in 2012, if you put $10,000 in gold, the return was very close to zero. Believe it or not, you would have approximately $10,000 today. If you put that same $10,000 in a large cap stock index, you'd have a little bit over $23,000 today. So let's look a little longer term. Let's look at the past 30 years. Well, we put $10,000 in gold. We would have made approximately 435%, which is a little over 4 times your money. You'd have $43,500 a day. Had you put that in the large cap stock index, you would have had over 161,000. All right, let's go a little longer. Let's go 50 years. The $10,000 in gold rises 2,154% cumulative, which would mean you'd have $215,400, or you could put it in the largest US companies that represent the index, and you could have 1,454,000. So I kind of knew this going in, but I didn't know these exact numbers. Now, it's interesting as I was doing the research on this because a lot of the return calculations do not include dividends. Well, stocks pay dividends, gold does not. And in fact, that's one of the reasons gold tends to underperform over the long run. It's not a business. It doesn't have revenue, it doesn't have earnings, it doesn't have dividends, it doesn't have a product. It's simply a metal, right? So a lot of the comparisons that I was seeing when I was doing my research, they would show the Wilshire Index or possibly the S&P 500 Index, but they would just show the price and they wouldn't account for the reinvestment of dividends, which is very, very meaningful, especially over large periods of time. And if you didn't include that reinvestment of dividends, then the numbers aren't quite as separated as they are now. In fact, it's a closer comparison. Stocks still win, but not by as much. But in my world, we reinvest dividends. If it's not into the exact same index, it's into other similar indices. So gold. I'm sorry, I almost said gold wins. Stocks win over long periods of time. Now, that's not to say that gold doesn't win over short periods of time if we happen to time it correctly, which, I wish I could say I was clairvoyant and I knew the future and I could time that correctly. But there are some time periods, and I'll just mention a few. In the late 70s, gold did much better than stocks for about a 4 or 5 year stretch. In 2007, 2008, during the financial crisis, when some banks failed, others were close, stocks dropped 40% plus. Gold actually did better during those times too. So it is a bit of a bad news hedge, at least a temporary bad news hedge. And some like to call it a kind of like insurance for your portfolio. However, to get anything close to a meaningful insurance, meaning you might have to add 20, 30% of it to your portfolio to reduce those bumps meaningfully. Based on the long-term returns that I showed you on the chart, it's a very expensive hedge. In other words, you give up a lot of return for occasionally not dropping as much as stocks do. So that's the main reason why I haven't made it a part of my client portfolios or my own portfolio, because the underperformance over the long run, it just doesn't, it's just not worth some temporary protection. And I want to kind of diffuse another myth about gold. I've heard it, and I've seen this online. I've seen it and heard it called a safe haven. And that's 100% incorrect. And let me give you a couple examples. From 1980 to 1982, gold went from $800 an ounce to $350 an ounce. That was a 56% decline. From 2012 to 2015, it went down 40% in value. Those were a couple of the worst ones, but that's not a safe haven. If you want a safe haven, keep it in the bank, keep it under your mattress, as long as you schedule it on your homeowner's insurance, of course. But gold can be volatile. I think it's a lot of times more volatile than people think. So it's definitely not a safe haven. It can be in times of stock uncertainty, but when stocks are doing well, gold typically doesn't. And year to date, I'm sitting here in September 2022. You might get this video later, but I'm here in the fall of 2022. And gold is down 7%. And it's also a bit of a myth that it's an inflation hedge. If I had a working crystal ball January 1st, 2022, and I knew inflation would get out of hand, I would probably say buy gold, because people think that does well during times of inflation, and it does, but not always. Its record is spotty on that, and this is a good example. Inflation is worse than people expected, and gold has actually lost value because there's so many other factors that affect the price. So I hope that gives you some good raw data on gold and why maybe it's not all it's cracked up to be. And the main reason why it's not anything productive in the form of revenue, earnings, interest, dividends. It does have some uses in terms of jewelry and in terms of collectible, and for that it has gone up a little bit over time, but not anywhere near the productive capacity of the top 500 U.S. stocks out there. And I wanted to end with a couple quotes from Warren Buffett. And the first one I'll put up here on the screen. The major asset in this category, gold, current, a huge favorite of investors who fear almost all other assets, especially paper money, rightfully so. Gold, however, has two significant shortcomings, being neither or much use nor procreative. True gold has some industrial and decorative utility, but the demand for these purposes is both limited and incapable of soaking up new production. Meanwhile, if you own 1 ounce of gold for eternity, you will still own 1 ounce of gold at the end. And then one other quote from Warren Buffett that I'll put here up on the screen. You could take all the gold that's ever been mined and it would fill a cube approximately 67 feet in each direction. For what that's worth at current gold prices, you could buy all, not some, but all of the farmland in the United States. Plus you could buy 10 Exxon Mobils, so the entire company of Exxon, 10 of them, plus have $1 trillion of walking around money. Or you could have a big cube of metal. Which would you take? Which is going to be more productive and produce more value? So that's a bit of a second opinion on kind of what I've said. So I hope you all learned something. And as always, contact me if you have any questions about your personal financial situation. Thanks a lot and see you next time.